Hello, everyone, and welcome to the sixth instalment of More Than Tyres, brought to you by TyreConnect. Today's instalment is entitled The Current State of Auto Retail and Changing Consumer Preferences. For today's episode, we are joined by motor industry professional Stephen Bragg. Stephen brings with him over 20 years of experience providing industry best practice strategic advisory, consulting, audit and tax services to retail dealers, OEMs, distributors and suppliers throughout the automotive industry. Stephen, great to have you on board today and welcome.
Thanks, Anthony, and thanks for having me. There's quite a lot of ground to cover today, so I'll move pretty quickly through these slides, pointing out key automotive trends. But if you could, please record any questions you might have, and we can address them at the end of the presentation. A quick caveat: two things. This presentation was written before yesterday's announcement of the 7% drop in GDP, which technically puts Australia into a recession. Good news is a lot of the predictions we have in the presentation are pretty darn close to what the actual was. And secondly, just this morning, VFAX came out with their volumes for August. And as you may or may not have seen, Victoria for August was down 66%. Which is a significant fall. Actually, a little bit less than I thought it would be. I thought it would have been closer to 80%. And I've got some insights from some of my dealers down this way, and some really interesting insights from a recreational vehicle and a motorcycle dealer, that they're seeing actually quite a boom, even in lockdown states, which is quite interesting. So, if it's okay, I'm ready to start. If that's okay.
Yeah, we'll kick off, I think.
No worries. So, what are the key themes that I've observed from my clients throughout the pandemic and the resulting economic crisis? Well, on this slide, basically the three main key influencers that have been driving business behavior, and in particular dealership behavior throughout the current crisis is the suspension in insolvent trading laws. So basically, on the 25th of March, the government basically put a 6-month moratorium on businesses going into insolvency, and that's created some weird behaviors from businesses and directors, and I'll cover that in a bit of detail. Second big key driver is the JobKeeper program. It was almost as if it was written for the automotive industry. It works well for industries that have high turnover and volumes, clearly that were highly impacted by the lockdowns, and are driven by high costs with employees, and it sort of really helped a lot of our dealers along. I think Eagers, for example, had over $60 million of JobKeeper payments received in the half year, to June. So in just under 3 months, they received $60 million of government subsidies, which is quite significant. And the third main driver keeping businesses, I guess we'll call it afloat, was the commercial code of conduct for commercial leases, and that basically said that landlords couldn't kick their tenants out without due cause, and quite a significant lot of hurdles, which has been quite difficult for landlords. So we always have to think of both sides of the coin. Clearly, as a retailer, it's a good thing to have deferrals or abatements on your rent, but the opposite side of the coin is these landlords are going through quite a significant crisis at the moment, and their business model wasn't set up to deal with anything like what we're going through today. As I mentioned before, I announced yesterday the June quarter GDP drop was 7%, which was significantly more than what the analysts had expected. They were actually expecting somewhere closer to 5%. To put that in perspective, for the year, in total, the entire motor industry contributes about 1.2% of overall GDP to the Australian economy. So the drop in June, over and above the expectations of the analysts, was more than the entire industry itself. So that puts it in a bit of perspective how big those drops are. If we go to the next slide, so how are my dealers responding? I'm calling this the self-help crisis management. It's sort of the new normal. Everyone's gone into crisis mode initially in late March and early in April, doing lots of forecasting from the financial perspective, looking at their burn rates, prioritizing who they pay, building that balance sheet strength, taking out any equity lines they can. At the moment, if you think about it, interest rates are as low as they've ever been, and I don't think they'll ever be any lower. So right now, if you have access to that credit, getting that drawn down and building up your working capital and a war chest to get you through to the other side of this crisis was priority one. Really leaning on a management team and their experience and their expertise to really buckle down and get through. JobKeeper and JobKeeper 2.0 is essential for the survival of the industry and for most businesses. As the government said, they want to put everyone into hibernation through these lockdowns to get us through to the other side. And I'll cover off what that means and how I think that's going to play out. Because whilst this is all very strikingly negative at the moment, I think there is hope and there is upside at the other side of this. And then a lot of dealers are looking at exit scenarios where they don't have if they didn't have a good succession plan in place, they're looking at their succession plan or looking at how they exit the industry. Because I think this for a lot of dealers, this is the straw that broke the camel's back. Who were the key stakeholders that have been obviously impacted? Employees, number one, stood down or put on the JobKeeper. Lendors to dealers have been very supportive, but within limits, and we're seeing that support wane. We're now 6 months into this. There's a bit of fatigue starting to creep up, not only from the community in general when it comes to lockdowns, but to the support that's been extended by lendors and other suppliers. OEMs actually, I've been quite pleased, have been very flexible targets and have actually behaved themselves quite well, in my view. And I hope to see that to continue, especially with supply constraints that are coming down. And we'll cover that off a little bit further. Landlords, they've been the least flexible, but that's because their business model really doesn't really cater to anything like this. Imagine landlords are similar to the airline industries. Overnight, their entire revenue has just been turned off, and the tap turned off, and they're still sitting there holding an asset and typically a liability on the other side with the bank, which they have to make do. So it's really starting to bite for these landlords and for commercial property companies. We've seen Center Group and others take massive write-downs on their property portfolios and show quite significant drops in revenue. I think Center Group had a 4.6 billion write-off of their property portfolio and a drop in the 2 months of when the pandemic really hit last year, a drop of something like I'm going from memory, about 300 million in turnover. But I think it might have been actually more. Key suppliers, dealers are looking at who they pay or defer, and I guess from a good point of view, we're seeing most businesses actually really trade within terms, and from both sides, right? So you're paying within terms for your key suppliers, but also monitoring those customers that you would normally extend a bit of credit to, making sure that you're not getting yourself in any risky situations. The ATO and regulators have been really kind in letting us defer our payments. They haven't given any relief, but they've allowed a lot of deferrals, and we've seen a massive shift, and we'll cover that in quite detail, to consumers moving to online and omni-channel approach. If we're looking on the next slide here, what industries and sectors were most impacted and by what geography? Overall, retail and automotive in particular has been impacted, obviously, in every geography in Australia. Transport, tourism, hospitality, and construction and real estate, again, all very much impacted Australia-wide. But if you look at the specific states, Queensland, for example, agriculture, hospitality, and tourism, which you'd expect. New South Wales, hospitality, tourism, retail, and aviation, which is quite interesting. But I guess that makes sense with most of the aviation hubs being in Sydney. Victoria, agriculture, construction, and wealth management. and then our friends out in WA, hospitality, tourism, and building construction. The interesting thing about WA, and I guess even Australia-wide, Queensland, mining's been quite strong throughout this, and I think mining, again, similar to the GFC, will be Australia will be leaning on mining as the sector that will propel us through what I think will be a pretty significant down and then up. So as other countries start to spend money on infrastructure to stimulate their economies, they're going to need all the stuff that we dig out of the ground here in Australia to ship over, so iron ore and all those wonderful things. Now we're going to look at retail sales in the economic landscape. Now the interesting thing is retail spending has been a bit counterintuitive. So these next slides are going to be talking about when will retail sales slow, because typically during a recession you'd expect everything to slow down. Well, for retail it's actually sped up. So retail sales have outpaced overall spending, and I actually think that'll accelerate throughout Q3. So we've just gotten the numbers for Q2. Q3, I think we're going to see it do that again. It's going to stabilize in Q4 and then start to drop in 2021. The big impact is on all this is the stimulus measures by the government on household cash flows and their discretionary income, and it's been quite significant when you start to look at the household income, savings rates, and where they're spending their money, and then obviously looking a bit into the future and where that's all going to land. If we look at I think there's some good news in all this, and obviously clearly bad news. So the economy will recover, and there are some positive signs out there. So I think through all this, we've got to take all of our key takeaways here need to be about, okay, this is what's happened, but what can we do? There's things you can control, things you can't control. So, I can't control the fact that I'm stuck in Brighton in my bedroom and locked down for however long, and who knows how long that's going to be. But if you look on the left here, there's a chart. We'd done a forecast of GDP for Australia, similar to the RBA. We expected 2.5% GDP growth for the next 2 to 5 years. The economy just continues to tick along a bit. After the pandemic struck, we did a forecast in March, and you'll see there that we expected a pretty significant drop and then a trail up. And then post the initial hit from late March to June, we did a reforecast here at KPMG, and we thought it would be much less. Now, if we redid this now as of today in August or September, it'd be similar, but it'd be somewhere in between that March and June forecast. So I guess the important thing is we see a significant decline, but we do see it coming back, and it's going to take 2 or 3 years for things to get back to where they were on the same trajectory that we were on. But I guess the good news is if we look at New Zealand there on the right hand side, pre-crisis spending was bobbing along, and during the crisis we see a sharp decline, and then we see a sharp recovery post getting through the crisis. Now we all know New Zealand's had another dip back into lockdown, but I guess the good news you can see there is once things open up, there tends to be quite a good bounce and a rebound. And I guess for the motor industry, my takeaway here is if you look at volumes in late May, June, and July, they demonstrate that there is basically a base level of demand for new vehicles, and dealers are finding ways to close deals and to deliver product. So I think the market will end up somewhere around 20% down for the year, and that'll put us somewhere between 800 and 850,000 units for the year. I think that's sort of the base level of demand for Australia, and it wouldn't get much lower than that, even if this is a protracted recession. If we look at the next slide, whilst retail's been going strong, it's been different across all the categories. So some of them have grown quite well and they're surging, and others are really being struck they've been impacted quite heavily. If you look at the surging categories, they're all the ones you'd expect: supermarket and groceries, electronics, and some interesting ones there are alcohol, hardware, furniture, and recreational goods. Now, the categories that have been significantly impacted are clothing. So clearly, we're not going out as much. We're not going to work. So there's a lot less spending on clothes and footwear, and also a lot less spending at cafes and restaurants because clearly you just can't go. But there's also been a bit of a sharp decline in takeaway and other department stores, which is quite interesting. But all that means is people are spending more time at home, so they've got more time to cook. It's not the same sort of lifestyle that we had pre the pandemic. Automotive sits there in the middle, and other retailing and AC. And if you look at automotive, it really did have a tale of two halves. The end of the first quarter, or in the beginning of the second quarter in April, was a steep decline of 50%, as we know, and then a steady, and then a rebound in June, July, and obviously August is looking okay for the rest of the country outside of Victoria. If we look at the various forms of stimulus and how they're influencing retail sales, the chart on the right is quite interesting, because if you look at the average Australian household actually had an increase in the June quarter of 5% to their discretionary disposable income. That equates to $13 billion. And how that comes about is there was a 4.5% drop in wages, 2% drop in other income, about a 1% rebound or deferral in mortgage payments, 4.7% from the government assistance, JobKeeper, JobSeeker, and then a massive 6.1% in superannuation drawdowns. So the superannuation contribution was $18.1 billion from April to June, and 2.4 billion Australians took part in that. That's good news in my view, because in the end, what we're seeing is we've got people pent up in their houses, locked down, and we would have seen this in New South Wales and other states where they're not currently in lockdown. Let's be blunt, they're cashed up. They have the intent to spend money. Once they're let out of their houses, they spend it. So the good news, I think, is we will get a bit of a V. I think it'll be a protected V, and I think the latest is it's going to be like a Nike swoosh, is what they're saying. It's going to be a swoosh. But look, the important thing is getting the health crisis under control, getting people back to work, and getting them out there spending that money, because we will see the super withdrawals will wane, and the impact to household income will be a drop of somewhere between 3% and 6%. So we go to the next slide. So how much superannuation has actually been withdrawn? There's a chart there on the left which tracks the weekly withdrawals in billions. So billions with a B, and on the right there's a cumulative chart by week or by fortnight, showing as of July 12th there was 25 billion withdrawn, and the latest data I got was the 10th of August. There was 30 billion withdrawn, and Treasury believes it'll land somewhere around 42 billion. But we have to keep that in perspective, because 42 billion sounds like a lot of money, which it is. It's a lot of money. But overall, the superannuation retirement pool is $3 trillion. So it's actually not that big relative to the overall superannuation pool. So where have Australians been spending the money? So on average, 4.1 million people have made claims, withdrawing on average $7,500. They spent, in the first 2 weeks of withdrawing that, they spent $3,600 in the first round and roughly $2,900 in the second round. And 2/3 of that spend has been going to discretionary items, so clothing, furniture, restaurants, and alcohol. They've seen some going to gambling. Now, these are, we can always point out the bad things, but I think again, it comes down to what I just said. There's a lot of pent up demand. And people have the cash to spend, so it's actually a positive in my view. Clearly, there's always going to be people spending money on things they shouldn't spend money on, but you can't stop that. The interesting thing there is it's been quite consistent that the 22 and 24% spent on essential items, and 12 and 14% spent on debt repayments. So people are paying off their credit cards. So there's been less spending on credit cards and down payments on credit cards. So overall, I think consumers will have a bigger capacity to borrow, more cash in the bank, and a want or need to spend money. So if we get the health crisis under control, things will get much better, which is
good in the long run as well, I imagine.
Yeah, very positive, very positive. And I guess where they're spending, where they're paying down credit card debt, as long as they don't go back and redraw on that credit card debt, that's actually a really long run positive in my view. Because I don't know of any superannuation investment returning 20%. And then if you look at the forecast for the rest of 2020, so Q3, there's an expectation that the household income will increase by another 3%. Again, that's basically the fall in wages offset by government assistance, and then the 3% is the superannuation. And then if you go into the December quarter, so the quarter we're about to head into, October to December, it looks to be flat. So, but I do expect post December, so into 2021, that's going to start to trend downward, because there will be some long-term unemployment out of this recession, as there always will be. And that takes time to then rebound itself. But I guess the key takeaways here is, what are the impacts of these shifts in household financial positions going to have on consumers' intention to buy a car? I think there will be a significant demand and push for more car sales as consumers shift away from public transport to personal transport. And I think there's going to be a lot more case driven on average after the pandemic, and we'll cover that in a bit later, that I think the case driven clearly has dropped quite significantly during the pandemic. But after the pandemic, more cases will be driven. So I think people like me will be looking to buy a used car for business purposes, so that I don't put a lot of Ks on my new car. And
do you think it will affect new cars more than used cars, or where do you think that'll impact the most?
I think there'll be more downward pressure on new cars and more upward pressure on used. I think there'll be an increase in demand for used, as we're seeing, and less capacity or intention to buy newer cars. So, supply will play a big part of that. For new car supply will be the issue of 2021, in my view. And then I guess the key to all this is the implication on credit risk for the finance companies. So what will the finance company do when you have JobKeeper or superannuation withdrawals on your credit application? Does that so I'm hearing some interesting stories out there that finance companies aren't too keen on people who have JobKeeper, which sort of makes sense. But the other one is, they're also not very keen when they see superannuation withdrawals on your credit report. So look, I think all that will, because it's 4.1 million Australians who've partaked in making a claim. So I think that I don't think the finance companies want to exclude themselves from such a big pool of customers. Okay, if we just move on to the next one. So now we're going to look at the customer and how they've changed as a result of the pandemic. There's going to be some permanent shifts in consumer behaviors, and then also some shifts in consumer behaviors that started before the pandemic that I think will be accelerated as a part of this crisis. So this is a big slide, and I'm going to sit on here for a minute so you can take it all in. But we've basically gone through a once-in-a-lifetime event, and it has changed us. We just don't know it yet. I think a lot of us do know it, but we've been changed. And if you look, this slide goes all the way back to 1900, so it's 120 years worth of GDP. So this is GDP versus the population, and it's broken up by the generations. So if you look at the bottom there, that little red bit is the cumulative percentage of people that are still alive at the time of these certain events. So each event circled in red there are significant GDP declines that we've experienced here in Australia. World War I, the Great Depression, World War II, the 83 recession, the oil crisis, the 91 recession, and then that was the last recession we had, 1991, and now we're here in 2020, and we've now had probably the worst recession. So we predict a 6.7% drop in GDP. It was actually -7, so we were pretty close. And that's probably only outpaced by the Great Depression and World War I. If you remember, World War I also came off the back of the pandemic back then in 1917. So this is probably one of the worst downturns in the economy we'll ever experience, and it will be a pretty much a life event that will define Gen Z and Gen A, who are our children and our grandchildren at the moment. And I guess the only half the population was alive during the 83 recession, and just over 60% was alive during the 91 recession. So for the most part, this is the first recession ever experienced by a large portion of the population. So so how does that shift basically present itself? So what we value and how we make decisions are going to change, and what that is it's going to be driven by some key things. So working from home more than we've ever worked from home, and I think a lot of that's permanent. Even as restrictions lift, at least for a number of years, working from home more than working in an office, especially for office-bound people, is a permanent thing. A focus on wellness, a focus on safety and convenience, a focus on simplicity, making your life better, and more needs-based consumption. So so in my view, when you look at it from a real 10,000 foot level, it's a shift from complexity to a simple, more meaningful life. And people are no longer consuming for consumption's sake. Because it used to be, if you think, and it sounds weird. We're only talking about less than a year ago. When you talk about even January, even last year, last Christmas, it was bang bang. You just have a busy life. You're always doing something. I guess I'm speaking from personal experience, and it's moving from here to here to here, doing this, doing that, and just you're always consuming all the way through that. Now my life is much more. I'm trying to get the house in a way that is comfortable for the family. Everyone has their own space. You're getting new furniture. You're improving your house, and we'll see how that all really plays out in retail spending. But I think from an automotive point of view, you're seeing a lot more outdoors and a lot more wellness consumer spending, and that's a shift from spending on overseas holidays and big trips into, hey, I'm going to get myself a 4x4, a big SUV, like a bigger car to go on a big family holiday, a big driving holiday. I'm going to get my car serviced and fixed up and make sure that it's ready to go on the big trip. And then secondly, I'm going to buy some toys. I want to get myself an off-road bike. I'm going to get a caravan, whatever it is, like a little boat, like a dinghy or whatever. So there's a lot more spending in our arena. It's just shifted from luxury to because there was a big push, up to December. If you haven't forgotten what happened, luxury was actually doing this going in this year, and now luxury is sort of bobbing along. I had a big jump in June, but that was more because of stimulus measures. But I think we're going to see a big shift from well, we already saw the shift happening, but in more earnest, going to bigger SUVs, 7-seaters, things that have towing capacity, all that sort of stuff.
Yeah, I think it's definitely be a bit of a reset for a lot of people, and it's a change priorities as well. So.
Yeah, and I think there's more of a shift out as well. So Australia, as everyone knows, is very much living in big centers. So Melbourne, Sydney, Brisbane, Perth, Adelaide. There might be more of a shift out to the outer suburbs, because if you don't need to travel to the city all the time, it would be nicer to have a bigger house with a bit more space, especially if this is going to continue to be a health crisis for a long time. I'd much rather be in a space where I have a backyard and a place to go play and a bigger house rather than having a smaller house closer to the city. So I think there's just a whole mindset and a priority shift in the average Australian. So how has spending changed during COVID-19? So we've got monthly spending by category here from January to June, and you see some real key interesting trends. So the one I like to point out first is alcohol. So basically, there's been a massive shift from drinking at the pub to drinking at home. I'm not sure if we're drinking more, but I think we are. I'm not sure if that's a good or a bad thing either, but at least it's a coping mechanism. So I love to see that information just for Victoria from July, August, and September. Yeah. I imagine it'll be through the roof, particularly in my household, in my neighborhood. But anyway, if you remember back to that last slide where I said we're looking at wellness, safety, convenience, better houses, all that sort of stuff. You see spending on hardware, furniture, and houseware, and all that stuff. They're all really increasing and accelerating that increase. And then supermarkets, there was a big shift from in supermarket and groceries and essential items, and you see March and April, and then a big surge in May and June. So if you think about what we saw as a priority early in the pandemic was toilet paper and some essentials like canned foods and things, and then that shifted from toilet paper to alcohol. So I'm not sure if there's any correlation there, but it is an interesting thing. And then clearly electronics and recreational goods. So, you know, that's a big shift. When you look at May and June there's that recreational spend, a 37 and 41% increase May and June for recreational goods and electronics is basically that. That's the shift of, hey, I'm not going on holiday this year. Let's spend money. Let's take it from there and put it here. And that's what's happening. And then for the others where there's massive declines. So clothing in April and March, significant declines. It kind of came back. I think as people started to buy things online, it started to come back. And then clearly cafes, newspapers, and footwear have all been significantly impacted. I think that newspaper and book retailing was always a downward decline, but it's just been accelerated by the pandemic. KPMG did a global survey and a study of consumers in the new reality of COVID-19, and Australia was part of that survey. And I think the most interesting outtake from that was that, and it was number one before, but value for money was the number one key driver for any purchase decision by consumers. But that's really been pronounced, and you would expect that, right? So that makes a lot of sense. Hey, I've got a lot of uncertainty about my job and my income. If I'm going to make a purchase decision, I really want to spend the money on something I get value for. But more importantly, that is Australia actually ranks number 3 out of the entire globe for that question. So Australia, 80% of Australians surveyed said that value for money is number 1. So what does that tell us? It tells us that there's going to be a significant pressure on pricing, and we'll cover off why that's important later. But you'd assume that obviously any pressure on pricing is going to be a big impact for retail and specifically automotive retail. Next is this the shift to online. So again, some of these behaviors we're talking about and how people shop. So first is the shift to online. During the GFC, we saw e-commerce accelerate from 3% to 6.5%, which was basically a 100% increase during the GFC. We actually expect on the shift to online to triple during this pandemic. More particularly because in every disruption event, there's always a more shift to more efficient ways of doing business, which online is, but it'll be a permanent shift, and it'll be more significant because clearly we're locked down, and digital dinosaurs are even learning how to online shop now. My parents, my grandparents, everyone's shopping online these days. And as part of that survey, we asked Australians, were they likely to continue to shop that way? And just under 50% said they would continue. So that's significant. And I think that's a permanent shift that we all have to take into account. I guess I was going to mention, I had a few conversations with clients down here in Victoria. Whilst the overall car sales were down 66%, they were still able to transact, right? So they were still able to do deals with customers online and do click and collect and contactless delivery. So they're still transacting. I guess the important takeaway is I had a conversation with a big motorcycle group down here, and they've actually traded very, very strongly. They hit all their targets and their internal budgets during this period, and they've been able to deliver quite significantly online. So they were a big online presence in any case, but their online presence, their online sales in the last 6 months have tripled.
Wow.
So if you're not online in earnest, you need to be, but it's a permanent shift and it's not going to stop. Another key trend in consumer behavior is shopping is gone local. So we've seen very pronounced trends in local shopping within your 5K radius of your house. 83% of the Australians surveyed said they would continue to shop locally. I think that's probably true. I don't think it'll be that pronounced, but I still think there is a big shift to shop local. What's the takeaway here for dealers? It's pretty much well known, or the latest information I have a car buyer will look at basically 900 pages of online content before making a decision to step foot into a dealership. So when someone's come to your dealership, they've done their research. So, yeah, at the moment, the average visit to dealerships by someone buying a car is 1.5. So they go to your dealership and maybe one other. That will become one. When they're ready to buy a car, they're going to come to your dealership and buy a car. And what they'll do is they'll do all their research. They'll know what car they want, what brand, and they will pick their local dealer and go in and say, hey, I want that one. I'm going to pay this much. And that's it. That's a good thing.
Yeah. I think they're better research than ever. Like the way that they are shopping is different. Just spending a lot. Technology's coming a lot, and a lot of people are shopping online, getting better educated. And like I said, it just comes down to that's what I want. And that's where your visit starts to drop off.
Absolutely. So I think the key there is to make the most out of every transaction and make the purchasing process as smooth as possible. And I think a big key to that is that every department needs to do what it does best. Finance needs to make the process smooth. Service needs to make the process smooth. Delivery needs to be smooth. So it's my experience in America. I'm American, if you can't tell from the accent, but my experience in America in purchasing vehicles is significantly different to what I've had in Australia. Whilst it's not the worst thing I've ever experienced when I bought a car here, there's a lot more that can be done, and the process just takes way too long, even still. But that's for another discussion.
What do you think? What do you think dealerships could be doing better to get a better opportunity? Well, to get a better look at that opportunity. Obviously, if consumers are visiting less, what can they be doing on from all departments to get better opportunities?
You could do a large portion of the transaction online. And there's a shift towards that. Like a lot of the brands and dealers have improved their online portals to allow for a lot of that. But look, there's a lot of regulation and finance and consumer laws that had to change to get there. They have changed now. It's just a matter of educating the customer of comprehensive credit scores. Because a key piece of all the contract and transacting is getting the finance sorted. The dealer needs to be the path of least resistance for a customer. I shouldn't have to pick my vehicle, do a contract, do a deal with the dealer, and then go to a bank and then start negotiating with them about getting a loan and do all. It should all just be as easy as possible, one path and very smooth. And it all needs to be integrated. That's the key.
Obviously, a lot's been done over the last couple of years to streamline that. Yeah,
we've taken a few leaps and bounds forward. There's just a long way to go. We should be looking to transact with a car purchase in less than 2 hours. At the moment, it's probably significantly more than that. I'd say, on average, probably around 4 or 5 hours. Okay. The next significant consumer shift is their shopping rhythms. So this is was an interesting study of Victorian shopping. This was obviously again pre the latest lockdown, but we've seen a shift from the Sunday shop being the Monday shop, and the Saturday day out being Sunday, which is a bit strange. So everything's basically shifted a day, and the weekday shop has really dropped significantly, and that makes a lot of sense because we can't talk in that many extremes, but a lot of people are working from home. So with working from home a lot more, you see a big decline in the weekday shop because you would go before or after work to do a bit of shopping, and then the Sunday shop's now become a Monday shop, and your Saturday shopping day is now done on Sunday, which is quite interesting. And then the other shift is in the timing of shopping. There's been a real shift to lunchtime shopping, which again makes a lot of sense. So if I'm in lockdown and I'm working from home, I'll duck out to go to the shops during my lunchtime. I'll take a lunch break. versus if I've driven to the city or driven to my place of work, I'll hit the shops on the way home. Yeah. So I think whilst again it's quite pronounced here, I think that shift is permanent, but just less pronounced. As people shift towards working permanently from home, or more so working from home than they ever have before, you're going to see a shift back to people shopping at lunch versus after work. Okay. So what does this all mean, and what are the impacts on the industry? So I guess for me, the mega trends that were already happening in the industry are only going to be accelerated by this. So the impacts of EVs, AVs, brand consolidation, network consolidation, all these sort of things are going to just be accelerated through this pandemic and the resulting economic crisis. So when I go in to do a strategy for my clients, we use the Horizon model, specifically for crisis moments. And so I'll explain it to you really quickly, but Horizon 0 is the reaction phase, and that's usually led by the CEO or the leaders of the business, and that's really focusing on safety, making sure that like all the immediate challenges are met, and that employees, customers, and everyone are safe, and the business survives. Horizon 1 is resilience. That's usually led by finance. You need to ensure that the organization is stable and sustainable and viable, and that's where you're doing all the forecasting and working out, getting the balance sheet right and making sure everything's okay. Horizon 2 is recovery. That's led by the business, usually investing in all the opportunities that you have, but then also being aware of the risks and trying to get to the other side of the current crisis. And Horizon 3 is what's the new reality. So that's where your strategy basically lets you focus on growth, and you emerge off the back of the current crisis as normally as a different business. If you look at those four horizons, I'd say most OEMs are between 1 and 2. But unfortunately for dealers, I think a lot of dealers are still in 0 down here in Victoria, or in other geographies, other states, they're between 1 and 2 as well. But unfortunately down here in Vic, where there's a lot of dealers still in that reaction phase, trying to work out, how do we do this? How do we stay open? What's next? As the government announced what's going to happen next and how we do this, and how do we proceed to reopen our businesses? So key in all this is there's a little chart here on the left. Once it comes up, is it showing for everyone else, or is it just me?
I've got the windy wheel going.
The wheel. The graphics it's way too detailed. Well, when it comes up, we'll see it. But basically, I believe stabilization is a long way off. So if a business is looking for stabilization, you're actually putting yourself at high risk. I think stable trading conditions are about 12 to 24 months away, and that's primarily driven by the health crisis. So as the health crisis ebbs and flows, businesses need to be agile and really able to basically move with pace to deal with these issues. And yeah, the graph sort of explains it a bit better than me just trying to talk to it. But yeah, hopefully it comes up. Let me see if I can get it to work. Oh, there we go. There we go. So hopefully that what I just explained makes a lot of sense. But here on this graph, the red line, and this is for conceptual purposes, the red line is the health crisis. As if you take Victoria for example, if the health crisis increases in April, May, and then sort of declines in May, June, and then reemerges itself, probably a bit more pronounced than that in July, the impact on the economy is quite significant, and it sort of follows the impact from the health crisis. So the knock-on effects of lockdown are going to be significant, and you have to be prepared to move between those horizons. So if you've gotten through Horizon 0 to Horizon 1, and then Horizon 2 to recovery, you have to be prepared to go back to Horizon 0 again. If there's a resurgence in cases, you need to close down and lock down again. So I think for the next 12 to 24 months, businesses have to be really agile and able to move between those horizons pretty quickly. And then I guess on top of all that, and again, we can't spend enough time on it, but there's also a geopolitical crisis happening between us and China, and that's going to cause problems for certain brands within Australia from an automotive perspective, but also overall in the general economy. So this whole geopolitical thing where China's playing funny buggers with everybody, it potentially might have some significant knock-on effects to the economy, as you would expect. But typically, when I'm doing scenario analysis and war games with my clients, these are some of the future possible retail scenarios that we've come up with. I've put in red boxes like the key ones for automotive. Consumers, I believe, are shifting their habits to online, and I think the pandemic will be a step change, similar to what we saw in the GFC. So GFC, we saw it double. I think during this current pandemic, we'll see it triple or even further than that. Cost of goods sold will increase due to supply constraints and further protectionist measures. This is the China thing. Even the U.S. and others are being a bit protectionist at the moment. And I think important to that is we have to remember that during a recession, Australians value for money is their key decision driver. So price will have a downward pressure, costs will have an upward pressure, margins get compressed. So it's going to be difficult to trade profitably during this period, and dealers need to be really proactive throughout all of this. Leases for retail is going to need to be flexible, and I think the real pain through this recession and the pandemic are going to be is going to be felt by basically two segments of the industry, the retail sector and the banks. But the real estate sector is really going to feel the pain through all this. And then lastly, the one that I think will impact the automotive industry is a large proportion of workers are now shifting to working from home on a more permanent basis. And this will be a fundamental shift in the preferences of consumers and their demand for transport as they move away from public transport onto personal transport. One, because it's safer, and two, I think there's just going to be a drive similar to as I gave as my example. People will be looking to drive a used car for those long trips or for those work trips rather than putting Ks on their new car. Go to the next slide. There's going to be winners and losers, and we learned a lot of lessons in the GFC. Those businesses there in the middle: Amazon, Costco, Netflix, Dropbox, Kogan, and Airbnb. A lot of those were startups born out of the GFC, and now they're household names. I think we're going to see the same thing happen. In any time of disruption and significant downward pressure on the economy, there tends to be a lot of companies that are able to basically find a niche or to disrupt a current industry and to make themselves quite big and profitable in that situation. And the winners will be the businesses that can balance cutting costs and surviving the crisis to invest in technology or into in innovations that will get them a bit more dominant. Yeah, so Amazon is a great example. Prior to the GFC, Amazon, if you all remember, was an online bookstore, and then during the GFC, they shifted to basically becoming a massive warehouse for merchandise, and they invested heavily into digitization and a lot of innovations as in the back of their digital warehouses to basically get the best advantage to beat out their competition. So Amazon, as you know, is the biggest company in the world at the moment, one of the biggest. And if we look at how the scenarios are going to vary substantially for the different categories within retail, this is an interesting little chart here where we show categories that they're going to have to basically reset themselves, like travel and entertainment, and footwear and hospitality. There's going to have to change how they do things, completely change how they do things. There'll be categories that'll surge: games, toys, fitness, food and liquor, home improvement. There's categories that'll have to modify their business as usual, but they'll just continue to go. So office supplies, home appliances. But then there's the categories that have to transform themselves completely. And automotive unfortunately sits in that. But automotive was there previous to the crisis in any case. If you think of all the things that were transforming the industry prior to this all happening, we were going through a once in 100-year transition from internal combustion engines to EVs, AVs, agency models. All these things were already happening, and they're only going to be accelerated through the pandemic. And the industry needs to invest in that stuff now in order to transition themselves to the other side of and into recovery. And then the last slide here, we're at the end, is what I see are the big disruption themes that will accelerate and severely impact Australia. I think there needs to be a widespread uptake of comprehensive credit scores through education programs to customers, and that'll be the key thing into getting that whole sales process at the dealership seamless and key to make sure that as consumers emerge from lockdown, they're going to be able to go and transact, because that's what they're going to want to do. Everyone, consumers will have the intent to buy, the ability to buy. They just have to make that process easy, and the banks need to extend credit. Electric vehicles, governments haven't relaxed their emissions targets. Actually, some of them have accelerated their targets. And OEMs, from what I'm reading, are actually increasing their investment and doubling down on EVs as their transformation plan to recovery. Online omnichannel trends, whilst that was a theme and something that was shifting prior to the COVID crisis, it's only going to be accelerated clearly because for a long time we're going to be going through the ever-evolving health crisis, which is going to cause us to shop more online. There's a shift to agency. A few brands in Australia are doing that, as we know, Mercedes-Benz and Honda, and there'll be more. And that's only going to accelerate. And we've seen it happen in New Zealand, in South Africa, and other places. So it's coming. Things are changing when it comes to the business model for automotive. OEM representation, we've got 58 brands in a market of less than 1 million units. The numbers don't stack up. From an economic point of view, it doesn't make sense. There will be consolidation at a global level, as we're seeing all the Japanese brands consolidating somewhat, cross investing in each other. We're also seeing the European and the U.S. brands going into partnerships and a lot of things like Ford and Volkswagen and others. And then also locally, I think we'll see a shift back to distribution from national sales companies. So I think at the moment, of the 58 brands selling cars in Australia, all but a handful are represented locally by a national sales company, a sales subsidiary company of the global company. From a dealer network point of view, there's going to be consolidation. I think the pandemic will sort the dealer network into 3 categories: the consolidators, those who will emerge stronger from the crisis and will be looking to consolidate more dealers into the group. The remainers, those are dealer groups that survive the crisis but will be probably wounded from it and need to merge with others or exit. And then there are leavers, those dealers that have been hit really hard by this crisis and need to exit. I think there will be a shift in the dealer footprint I think from a physical point of view to a more online presence. If you think about it, dealers invest millions of dollars into a glass Taj Mahal and then a couple $1,000s into our website. So it makes no sense. Most of your customers are seeing you online before they ever see you. That whole experience needs to improve. It is improving, but it needs to improve significantly more. And last but not least, autonomous vehicles. I think similar to EVs, the shift is happening. It's just a bit longer on the horizon, and it's likely 15 to 20 years away. So we've covered a lot, and I've gone very quick. So hopefully there's some questions, and if there's anything we want to go back and revisit, happy to do so. But thanks for having me, and I'm ready for any questions.
Covered off a lot there, Stephen. I'll just go in. We have had a few questions come through, so we'll just bring one of these up. We'll start with this one here. So to what degree is social distancing changing consumer behaviour, and what is the role of digital tools in maintaining customer engagement moving forward?
Okay. Look, I haven't asked that question specifically, but I do know the social distancing thing has sort of, I guess, when I can draw my own experience. When I went to get my car serviced, it was interesting how we were all seated in specific areas in the showroom, because I actually, it was the first service, second service, but so it only took a bit over an hour, so I stayed. Yeah, I think the social distancing thing will see consumers less inclined to go to a dealership. But when they do go to a dealership, like I said earlier, they'll be significant. The intention to buy is there, so the transaction needs to happen, and I think more so than ever, dealers need to be more proactive in getting customers into the dealership. And I guess that sort of leans into the second question: is what's the role of digital tools in maintaining customer engagement? I think CRM systems, as hated as they are, need to be data mined at the moment, and dealers need to be really proactive in getting out there and establishing a relationship digitally with their customers, and finding ways to get them into the dealership. And specifically, I think with less kilometers being driven at the moment. Again, I'll give a personal example. Since March, I've only filled my fuel tank up once, and I've driven like, I think, 600 Ks. So where previously I'd probably drive 12,000 Ks a year. So in that time, in that 6 months, I would have normally driven 6,000 Ks. I've driven 500. So what does that do for a dealer? Well, I think from a consumer point of view, I've only driven the car 500 Ks. Do I really need to go get it serviced? Yes, I do. So as a dealer, you really need to proactively go out and push your customers to come in, explain to them why it's important to have the car serviced, especially now that you're only doing less than 5 Ks per trip, and it's all that sort of wear and tear on the vehicles, more impactful than a long distance drive. So I think there's a lot of education of consumers that needs to happen.
And just move on to another one here, just tying into retention and getting your customers back into the dealership. What are the current client retention rates from the mass OEMs in relation to into first service, second service? Are we seeing any sort of trend in retention rates throughout the?
Yeah, that's interesting. I was speaking to a big group just recently, like in the last couple of weeks, and they're seeing a pretty significant drop off, 15%. Versus last year, but that's driven from two things. It's not only retention; it's also driven by the car park being reduced via volume. So we're now 28 months into the new car sales drop, and obviously more significantly of late. But yeah, so two factors. First is there's less new cars out there, and second, retention has dropped. And I think it's a mix of lockdowns, a mix of a lot of things, but yeah. And there's a Toyota dealer, so it's not like it's another one. It's Toyota, which is probably one of the better ones. So yeah, and I don't know if that's a short term thing, but I think the drop in car sales is a long term trend.
Is there, and what this sort of almost ties in, but what scope is there for service departments within dealerships up their game to support both profitability and retain customers?
Well, I think if I were a dealer principal right now, I would be pushing, and my OEM clients won't like this, but I would be pushing used cars. If you look at, and I think we'll go back to Toyota. Toyota's done a good job with their certified pre-owned. And there's a few other brands shifting to that, but I think if I'm in the service department, I'd be looking to shift and helping my used car department get vehicles ready for sale, and getting that time from purchase, trade or purchase of the vehicle to getting it onto the yard, and then secondly, actively promoting to get used cars back into the service department. And not being afraid of fixing cars that are 5 years and older. I think over time we've become quite lazy as we've focused on new cars and only had first, second, third, fourth, and fifth services, and not really focused on servicing used cars. So you'd be looking to up your mix of used cars in the service department.
Yep. Okay. We've got a couple of others here. Probably running short on time. What have we got here? This one here is an interesting one. How affected are the car rental companies as it relies on air traffic for a lot of its business? And what effect is COVID-19 having on the vehicle leasing industry?
I don't have a lot of information on this, but I do know what I have read. So everyone would have known Hertz in the U.S. went bankrupt, but locally, I don't have a great deal of insight, but I have heard that they've been obviously impacted quite significantly. And what I read recently about the leasing industry is they're down about 70% more recently. So it's massive impacts on. And if you think from a business leasing point of view, a lot of the company cars are being held for a longer period, which again makes sense because you're driving them less. So yeah, so very big impacts.
Yeah, interesting to see how that plays out. But I think that'll be all for the questions today. Like I said, we're probably winding up on the air, just ticked over an hour now. So I think we'll wrap it up. Look, thanks for having you today. Well, thanks for being on board, Stephen. Covered a lot of ground there. Had some interesting questions come through there. Also, a big thanks to our sponsors, Michelin, who have also provided us with a $500 towards Michelin tyres today. So that was actually a draw for all registrants, which was drawn earlier, and that's gone to Adam Dunn. So Adam, you'll be contacted shortly by our marketing team, and they'll run you through all the steps there. But yeah, like I said, that'll be a wrap for the 6th instalment of More Than Tyres. Absolute pleasure, Stephen. Yeah.
Thanks for having me very much. Thank you very much.
No worries. And thanks to all the attendees and everybody watching in future. Obviously has been recorded and will be up on social media and the likes.
Okay. Thank you.
Thank you.